So we are looking at the measurement of the cost, how to measure the cost of a PPE. Yeah? So let's dig into this. Keep the questions coming in the meanwhile. Deferred payment financing element. Now, when you are looking at recognition and you are purchasing a PPE, all right, at the cash price, obviously that is the cost. But if you are purchasing a plant and machinery over a period of time and you are given some kind of extended credit by the supplier, all right, which is rare, but it is given. It is especially for some things that are very slow moving and not many people buy that kind of machinery. So the supplier wants you to take the machinery and you say it's very expensive. So he gives you time to make money from the machine and pay. So sometimes they give you a credit period of 2 years or 3 years. Of course, there are a few things tied in here. So when you buy this machine, say for instance, it's 1 million ringgit, and you are paying in 2 years' time only. No payment intervening. They know you very well. It's coming from Germany, bloody expensive machines. So you're going to pay 1 million in 2 years' time. Now, of course, there is a time value of money. Even though it is not charged as an interest, you must discount it. And after discounting it, you must unwind the interest in the later period of time. Now, the question is, are those discounting and interest, is it going to be part of the cost of the machine? So let's dig into it and explain it to you as I go along here. So the cost of an item is the cash price equivalent. So remember, that's what the standard says, the cash price equivalent on the date you recognize it. Obviously, the date you bring it into your books. Now, if the payment is deferred beyond normal credit terms, you would normally expect 3 months, 6 months, or even 9 months at the very, very least. Whatever it is within a year. All right, within a year, you don't calculate time value of money under the standards, because the standards say, even though within a year there is time value of money, even 3 months there is time value, but all the standards say that it is not material, and so you can ignore time value of money or deferred credit payment, deferred credit interest if it is 12 months or less. It's only when it goes beyond, let's say 2 years, then you have to take into account. So if payment is deferred beyond the normal credit terms, the difference between the cash price and the total payment is recognized as an interest over the period of credit and charged as finance cost in the profit or loss. This means sometimes suppliers will sell you a machine for 1 million. So if you want they'll sell you for 1 million. If you can pay cash now within the credit period of 3 months, I will give you the machine at 850,000 ringgit. That means cheaper by 150. But this is the price, 1 million. If you want 2 years, I will charge you 1 million. You pay now, I give you a cash price of 850. What is that difference? The cash price equivalent is 850 and the total payment is 1 million. So it's 150,000, right? That should be recognized as interest charged as finance cost in the profit or loss. Unless you are constructing the asset, in which case that interest can be capitalized in accordance with 123. Capitalization of interest ceases, as I mentioned earlier, when the asset is ready for use, not put to use. Okay? All right. Next one. Yep. The screen just froze just now. All right. Exchange of assets. These things do happen. All right. Exchanging non-monetary assets with a combination of monetary and non-monetary assets. In fact, it is in one of your questions that I've also given to you, so we can learn more when we go through that. I think it's not that difficult. I've simplified it so that you don't get into to get the principle right. The measurement of the cost of PPE is measured at fair value. So if you're talking about PPE, all right, in terms of exchange of asset, is always at fair value. Because I am not going to give up something when the value of that item that I give up is very high. But in my books, I show it at cost. Suppose I have a piece of property. All right, that's a house, cost 500,000 ringgit. And let's say over time it's gone to 850,000 ringgit. Okay. So now if you got 850,000 ringgit house, and somebody says, can you exchange, your location and my location? I want to go to your location. And you also want to sell it off because, you want to go somewhere else. They say, oh yeah, that location is nice. All right, so what is your price of your house? It's about 850. The other party tells you. But yours in the books is 500,000. Would you exchange your property at the book price of 500,000 against 850? It doesn't make sense, right? You will definitely want to sell it at 850. Now, this is what we are talking about. So measurement of the item is at fair value. I will have to put at fair value. I may not value my property in my books. Let's say it's in a company, this 500,000 property. I may not want to value. But when I sell, I will sell you at the market price. Okay? So this is what we mean by measure at fair value in an exchange, unless the exchange transaction lacks commercial substance. Sometimes people create entry in the books. And if you look at a number of frauds in the world, right, there's a lot of frauds. And sometimes they create this kind of entries, between many companies, especially using all kinds of special purpose entities to create it. Now, that is no commercial substance, or the fair value of neither asset received nor the asset given up is reliably measurable. Let's say I have this piece of house which I say is 500,000, but I think the market value is 850. Let's say I have it in somewhere in I can't remember, those funny areas like Berenang or some place where it's all abandoned. Let's say I have a house there. What is the fair value? Nobody comes, it's all rotten down, broken down, and all, you don't even dare to go inside that space. So can you determine fair value? Cannot, right? So it cannot be reliably measurable. So if it cannot be reliably measurable, then you cannot measure at fair value. You'll have to take some other valuation that you need to do. This is the measurement of the exchange. Now, the word commercial substance here in the previous slide, all right, and I said see below. So the word commercial substance, let me get the pointer so maybe you can see better. All right. An entity determines whether when you exchange one house with another house, in this example, it has commercial substance by considering what? The extent to which you are expected to get cash flow changes due to the transaction. All right. Why do you want to actually change? Either you want to change your cash flow profile or you have other reasons for it. Okay. So an exchange transaction has commercial substance if the configuration, that means the risk, the timing, and the amount of the cash flow of the asset that you receive. So you're taking over another asset differs from the cash flow that you transferred out. Okay, that you transferred out. Then there is commercial substance, right? The entity-specific value of the portion of the entity's operation affected by the transaction as a result of the exchange. Now, sometimes you may have a shop lot and you exchange it to a shop lot somewhere else. Would your operations be affected? You must have a reason for affecting it. All right. Nobody changes for fun of it, right? And that will be a commercial value why you change. Maybe you are relocating. And the difference in A or B is significantly relative to the fair value of the asset. Now, if these are the elements in that exchange transaction, it means it has a commercial value. Otherwise, there is no commercial value and is probably a fraud, right? Now, another one on the measurement, on recognition of PPE. What about government grants? When you buy something and the government gives you a grant. Now, of course, not everybody gets grants, but of course, sometimes for tax purposes, you might get certain grants, or industry where government is encouraging a certain industry, they may give grants for you for startups. So the carrying amount of an item of PPE may be reduced by government grants, may be reduced. You see, the carrying amount of the PPE can be reduced by the grant in accordance with MFRS 120, which is accounting grant for government grant, and disclosure of government assistance. You see, disclosure of government assistance, all right, so under paragraph 28 of 116, which is PPE, this is government grants. So if you say you're putting up money to build an orphanage, and it's going to be 5 million to build this big orphanage, right? The cost, and you get a grant from the government, you apply from the grant from the government, and the government gives you a grant. Now we all know that under MFRS 120 or IFRS 120 or IAS 20, sorry. What you are going to do with the grant is you're going to debit your bank account and credit the income in the P&L account. That's what we are supposed to do based on the standard. But if it's for a property, you can set it off against the property. So you can see here that the government grant is 3.5 million, set off against the orphanage, and you get an orphanage building in this accounting record for only 1.5 million. Because that's the real money that was spent by you. The rest was from the government, okay? You don't put the government in a different state. There is alternative treatment on this. You can put the money that you receive by debiting the bank account and crediting a government grant on the liability side of the balance sheet. It's not a current liability. Yeah? So you just put a thing. All right, government grant given for building or whatever it is. Some people call it a fund. So the PPE is shown at 5 million in the books. All right, the PPE is 5 million. So you depreciate the PPE by 5 over the number of years. Let's say if the building maybe 50 years, 2% per annum, maybe, or maybe less. You see, depending. Don't take the amount as fixed because everything is very dynamic in this world. If the building is, badly constructed, it won't last 50 years. So you only know as you every year examine to determine whether or not the building has got any problems or not. And you can see many times new buildings sometimes crack, and then after a few years, everything is in very bad shape. Anyway, that is something else. That's impairment. So you can charge the depreciation against the government grant. Every year you credit the building orphanage building and debit the government grant. So you reduce the government grant over the years. In substance, you are using the grant to reduce, but that is not a very recommended way, but it is a way that is shown in the standard. It can be done. All right, and some people do this for whatever reason. Simply, they like to show a bigger asset. But the truth of it is, you yourself don't actually have 5 million asset, right? You don't have 5 million asset. The true thing is you have 1.5 million. And the depreciation on the 1.5 will straight away go to the P&L account, right? That is your building, right? So that's the impact of government grant on PPE. All right, now we go on to the next one. We'll pick up so that we can do all the other questions afterwards. Next one is the cost model after recognition. After, just now we are talking about before recognition and on recognition, now after. So after recognition, you can carry your asset at cost and you must depreciate it. And you must also test it for impairment. So this is something It's in the books, but many people never actually do the impairment because nobody asked them to do. In Malaysia, if you don't tell the directors about impairment, they won't want to do it, lah. All right, just because impairment means affects the profit. Nobody likes impairment, especially if it's significant figure. And public company directors are just as guilty for this kind of thing, unless it is a very professionally run public listed company where the directors are above everything and they say if it is required to be provided, provide. But many listed companies, have got some person who is built up the company and he will be the person who is always making decisions. The rest of the board is there. They are not going to challenge the person, the old man or whoever it is. So it carries on like this, lah. Now our standards are in this kind of scenario sometimes, you see. But some professionally run companies are not like that. So anyway, impairment is always important. Somebody to check the assets annually. The standards require us to do it periodically. So you actually got to do every now and then to see whether or not the asset still can realize the value stated or at least continue to generate income to determine the value in use. There are two methods, as I say. Either realize the value that is stated, that means if you sell it, you get much more or about the same, or if you continue to use, you can still recover the cost. Now, if you cannot do that, then we have to do impairment. Otherwise, our profit is grossly overstated. The distribution is grossly overstated. And who's to blame? That's why the standard is not followed. In the end, when the company collapses, the investor is going to suffer. And you say, what kind of accountants do we have these days? They can't even do the accounts properly. I look at the accounts like this looks okay, but next day the company collapsed. Why didn't they warn us somewhere in the accounts? All right, so something that today is very, very, very important because of COVID. The impact of the lockdown has caused a lot of problems, all right, because that one, I'm not going to speak on all the problems because we're talking on PPE. There are some PPE that was not running, and therefore there would have been a problem with the PPE. Right? Maybe you got to service it, you got to do a lot of things in order to bring it up from some PPE, the expensive one, got to be, they are best when it's running. They are not meant to be idle because inside the whole machinery tends to get rusty between all the moving parts, which you cannot see. And there's going to be an expensive repair work. So therefore, there could be impairment. Or there could be something. So who checks that? Nobody checks that, right? But it is something that could happen. You should make sure it's running well and make sure it's serviced and up to this thing for the PPE to last for that lifespan that you expected it to be. Otherwise, you have to do some impairment. Remember, impairment can be reversed. So it's about making sure that in case something goes wrong, you are adequately provided for. Now, measurement after recognition could be at cost, it could be at fair value. Now, this fair value, I've spoken a little bit. Let's check the slide again. After recognition as an asset, it can be, if the fair value can be measured reliably. So as I say, it must be measured reliably. Now, if you talk about landed property, it is easy to get it done, especially if you use valuers, professional valuers. Because professional valuers are doing this day in and day out. They live valuation. They live it every day. So they are able to know what sort of area, what sort of thing. But if you say, I want to value my assets in the company, my factory assets, all the plant and machinery, etc. Now that is very subjective. Because plant and machinery is not something that is regularly bought and sold in the second-hand market, unless you are in an industry where machinery is very easy to obtain. No need to buy new one, can buy old one. All right? And there are plenty of it in the market because it's a common industry. But we are going to some very high-tech industry or something that not many people manufacture, and your machines are all very sophisticated or very unique, not to say sophisticated. Now, if you want to sell it, people may not buy because I'm not in that industry. And it becomes even worse when the entry cost to your industry is very high. That means to say that you need to have a very high capital in order to start up an industry like this. And your machine is sitting there. So you have a very good machine, very high quality machine, but has no market anywhere because people don't want to buy. How do you determine the fair value? The fair value is the exit price, all right? So if nobody wants to buy, your exit price is lower and lower until it meets the scrap value, which is sad to say. So if you don't want to exit, continue to carry on with the business. And that's why you have value in use. All right. So that's why it says here, you can measure reliably, then only you can carry at the revalued amount. If you do not measure reliably, carry at the cost less depreciation plus impairment if the value in use is less than the net book value. So you test against the value in use. Now, while I'm saying test against the value in use is what the standard says, the real life practice of doing a value in use calculation can be very tricky and very not quite accurate because you're doing a projection of that machine. All right, the output of the machine and the sales eventually, or the recovery price. The issue is how sure are you able to determine the output and the selling price, the market and the market condition, the competition, etc., in the next 5 years? Are you absolutely sure? You're going to make certain assumptions, you know. Now, how are you going to determine that assumptions? Because if one element of that assumption is wrong, that whole valuation can throw in the dustbin already. Okay, so when you're doing valuation of all this plant and machinery for which open market is not there, then it's going to be tough. But if you're taking things like tractors or bulldozers or backhoes, which are heavily used because every contractor wants one, and the contractors, small contractors, can't afford to buy one, so they rent it. So there's always a demand for it. Okay, so that is an item easier to do valuation. So you have to look at it relatively. So the word measured reliably must be highlighted on this kind of topics. What do you mean by? Otherwise, it gets lost in that sentence, you see. If an item of property, plant or equipment is revalued, the entire class, all right, of plant equipment will, to which that asset belongs to must be revalued. So it's talking about entire class. That's why I mentioned just now to you, land is a class, land and buildings is another class. If you put land and buildings together, then all your land and buildings must be valued, which is even more expensive. Okay. The following need to be deducted from the valuation on the date. So when you value, you also got accumulated depreciation in your accounts, right? So you got valuation reserve and you got accumulated depreciation. So you must set off the accumulated depreciation against the valuation amount and also the accumulated impairment. So you can see this on paragraphs 43 to 62 and 116, and also on impairment, paragraph 63. How frequent do you revalue in real practice? As I said, 3 years. But sometimes 3 years could be too short a time. So depending on what are the things that you're valuing, landed property can sometimes be 5 years. If it is situated in a location where there is no steep rises in price. Certainly, we are talking about property inside KL. 5 years is too long. All right, 3 years, sometimes 2 years maybe. But maybe other parts like outer parts of the heart of the city and going on to the state of Selangor, or maybe into the outer skirts of Perak or Negri, that side. that will be a little bit more stable. All right. It may shoot up in certain pockets of areas, but certainly not everywhere. So when it says periodically, all right, periodically, the decision to revalue properties in the valuation model depends on whether the fair value difference from one year to another year is material. Come back to that definition of material. If you put up this valuation, would an investor say, oh, this property is really going up, significantly, is good. But if the valuation difference is so small, he looks at the figure, it makes no difference to him whether got valuation or no valuation, then it may not, I never said it is not, may not be material in that context. Now, that is a very simplified version. You have to look at the whole thing again. In financial reporting, not always only one thing will decide. It's a sum total of a few things that will decide, okay? And if it's not so material, then revalue them every 3 to 5 years. If it's very material, because the price is shooting up, you may not only do it 2 years, you have to do it every year. All depends on what kind of area that you're in. Hot area, medium area, cool area. You have to look at this now. So these are all real life applications. Now, when we talk about the entire class, remember I said here on this slide, talking about entire class, and I asterisk it. So this is what the standard says about a class. A class of property, plant, and equipment is a grouping of assets of a similar nature and use in entities' operations, okay? And examples given in the standard is examples of separate classes. And you can see here, A, land and buildings. So if you got 2 pieces of land and you got 10 pieces of land and buildings, so you want to revalue your land, you can revalue the 2 pieces of land. You don't have to touch this land and buildings. But if you put this land inside here, land and buildings, then all this will have to be revalued together. All will have to be revalued. Now, because valuation is a sensitive thing, it costs a lot of money. All right, so there must be a benefit. Valuers mint a lot of money. If you've got big properties, of course, they charge on a certain percentage. So you must balance the cost and the benefit. Other things, so like machinery is one class. Ships, aircraft, motor vehicles, right? Furniture and fixtures. Now, very seldom anybody will do a revaluation of motor vehicle. Any motor vehicle revaluation will go downwards. If you've got very expensive cars in your company, also people will not buy. Okay, not many people in business will buy a car in that kind as a company asset because you got no tax advantage, nothing. Unless you got private money, then you can invest all the kind of money that you like. But that's a different thing. If you're so lucky that you got one of those very expensive cars in your company that cost you about 1 to 2 million, and somebody says, I want to buy, then you're lucky. But accounts are not made on luck, okay? So fair value will drop a lot. Now, furniture and fixtures, well, most of the furniture and fixtures, that you see today and that I used to see way back in the 70s is a world of difference. Those days, furniture, when they say depreciate over 10 years, 20 years also, the bloody table is still there and the chair is still there, standing like a solid thing, because people those days used to use solid wood. Today, in the modern era, who wants to use that solid wood? It's so cumbersome, takes up a lot of space, and sometimes it looks very antique. Of course, there are a lot of people who like antique things, but those are people who like antique things. We're talking commercially. So nowadays, light furniture, rubber wood, that's why rubber wood comes in. Just look at your office, how many things that are there are made of chipboard and rubber wood and all this stuff. They're all from here. So because of this, furniture doesn't last as long as it used to be before. So sometimes when they say 5 years, all right, depreciation, how many chairs last for 5 years? At least not the ones I sit on. All right, maybe I'm too fat. So chairs can break after 2, 3 years, right? So therefore, sometimes as I always say, people never look at the value of the asset carefully. So they just calculate, they say, oh, furniture is depreciated at, 20% per annum over 5 years. So we calculate and get the right figure. But the substance is never checked. Chair broken sitting in the corner, right? How many times I've seen this when my staff do audit, all right? Because they do physical inspection of things, especially items that are significant, all right? Especially plant and machinery. I always train them to talk to the individual machine operators, be friendly with them. The best information you can get about the machine is from the machine operator, not from anybody up the line. They have no clue what it is. And even if you ask them, they will tell you an answer that you want to hear. But the machine operator is operating, you be friends with him, he'll tell you this problem or that problem, or very good machine, you get a good thing. So these are things about valuation. And if you want to look at fair value, and of course, bearer plan. Now, we talked about bearer plan. So if you want to do bearer plan is PPE. Biological asset must do fair value. Bearer plan is a class on its own. If you want to value it, plantation, you can value, all right? Maybe for reasons of selling over the company to another entity, you may want to revalue to make your balance sheet look good. It's possible, right? Okay. Now, this is the revaluation on a rolling basis, rolling, right? Paragraph 38 of MFRS 116. So items within a class, say land and buildings, are revalued simultaneous to avoid selective revaluation. So you cannot say, I want to value this building this year, that building next year, and that. You have to value all, okay? And the reporting, the amounts is not a mixture of partly not revalued, so it's at cost, partly revalued, so it's a valuation. That is not the way the standard requires us to do. But having said that, it says a class of assets, land and building, can be revalued on a rolling basis with a proviso that revaluation of that class is completed within a short period. All right, short period of time. That means yearly, the shortest is yearly. All right, provided the revaluations are all kept up to date. So your rolling means 1 year, you got a lot of assets. So naturally it's expensive. But you're going to do all that very, very quick. That means every year. One set this year, next set another year, and the third set, go back to the first set. Something like that. It's very close. Then you can do rolling. Otherwise, you should not do rolling. You read on paragraph 38. It's about rolling. All right, rolling. Now, recognition of the revaluation surplus or deficit. So now, after you have done the revaluation, you're going to end up with a surplus, or you're going to end up with a deficit, right? Now, this is the question somebody asked this morning. Where do we put it? Do we put this revaluation, the OCI? And what happens if there's a deficit, when it's a loss? Do we put in the P&L? So let's address that on this slide and the next slide. Now, if the PPE's carrying amount is increased due to revaluation, most of the time properties will increase. Unless you suddenly got a big sinkhole in your property, then the value will go down, of course, all right? And recognized in OCI, right? So all of the PPE usually, because of revaluation, go to OCI, and it ends up in the statement of changes in equity, all right? Under the heading revaluation. But the increase will be recognized in profit and loss to the extent that it reverses a revaluation decrease. Now, if last year you did a valuation of a property, all right, as compared to the previous year, the value went down for whatever reason. Maybe a lot of people, due to COVID and all, the market was bad, economy went real flat, let's say, and so there was no demand. And the value said, very hard to sell. So the value is much lower. Previous year was 100,000. This year is only 80,000. I mean, last year, 80,000. Where do you put that 20,000? Can you put that 20,000 in OCI? Answer is no, because you actually suffered a loss. That loss cannot come from nowhere. It must come from somewhere. That somewhere is your retained earnings, if you have. If you don't have retained earnings and you got a loss, it adds to your loss. And when it adds to your loss, where does it end up? Against the shareholders' fund. That means the share capital will be beginning to be depleted by this loss. Right? So that is the real scenario. Because if suddenly you close the company that day and got rid of all the asset, that asset is not going to realize. Who takes the hit? Is the shareholders, nobody else, right? But turn it around now. If it is a surplus, the surplus is on a long-term asset. So you don't put it in the P&L account. You put it in OCI, and it ends up as one column in the statement of changes in equity. All right? And it will carry on and on. Now, the sentence here says that if last year, all right, the increase is recognized in profit or loss to the extent it reverses a revaluation decrease. Let's go to the example. Last year, there was a loss of 20,000, 100,000 the valuation, but 100,000 is the previous year's valuation. Current year's valuation is 80,000. Current means last year. So there's a loss of 20,000 gone into P&L account. This year is gone up. Let's put some figures for just argument purposes. From 80, it's gone to 110,000. So you got 30,000 increase, Can you put that 30,000 in OCI? Not quite, because there is a 20,000 last year that went to your P&L, which was not an operational loss. So we reverse that 20,000 in the P&L, and the balance of the 10,000 goes to OCI. So you have reversed the situation to make it as if like there is no loss in the P&L account, because the property never really lost it, and the shareholders are not going to suffer that loss. So you must see the flow where it goes. Okay? All right. I hope that's clear. Now, if the PPE carrying amount has decreased this year as a result of valuation, this one we are talking about last year decrease, this year went up. Now we are talking about this year decrease. So where do we put that decrease? That decrease will be put in the P&L account, because we never revalued before. The only decrease goes inside P&L account. But if previously you revalue the asset and you got a surplus in OCI, previously if you got a surplus, then this decrease will go into OCI to reduce that surplus. All right? So if that surplus is not sufficient, the difference in the decrease after setting off the surplus in OCI will go back into the P&L account, the difference. So this is how you look at the two. And the reason why you look at the two is somebody takes the hit for the loss. The only people who can take the hit is the shareholders themselves. They make the money from the dividends or the profits. They also have to lose when their losses arise. Okay. Now, the decrease recognized in OCI reduces the amount of accumulated under the heading of revaluation surplus if you put it in OCI. Now, revaluation surplus included in equity for any item of PPE will be transferred directly to retained earnings when the asset is derecognized. So remember, your surplus on the PPE sitting in the statement of changes in equity in one column called the revaluation surplus. Now, when you derecognize, meaning you sold the property, that surplus together with any new surplus you have made will be added and transferred directly into share capital or equity. All right, retained earnings. Transferred to retained earnings. It doesn't go through the P&L account and then go to retained earnings. It's direct. That's why you can see that it's transferred directly to retained earnings when the asset is, and this is maybe, it didn't say it must. See the words maybe. So you can put it through the P&L if you want. All right? Usually they won't put it to P&L because that will distort the year in which you make the profit, and next year profit goes down. So people like it in the year that you say, oh, the numbers went up. And the following year, the numbers go back to normal. People don't see this. The investors, hey, last year, this year gone down. Hey, no good, this company. You see, before you try and dig into what exactly went on, so people who don't do that get a wrong impression. So management normally does not want to do like that and put it into P&L. So directly let it be there, all right? Now this is done by transferring the whole surplus when the asset is disposed of. Transferring from where? Revaluation surplus in the statement of equity to retained earnings in the statement of equity. Transfers from revaluation to retained earnings are not made through the profit or loss. All right, so paragraph 41 says that don't make it through the profit or loss, but here it says may be transferred. So you got to make a judgment here, how you want it done. So far, ever since the standard came to force 2012, all right, nobody that I know, maybe there are people who have done it, who have actually passed it back into the P&L and come out of it. Always is transferred directly into the retained earnings. Okay, I hope that is clear. Now what you see on the board is something wrecking the whole building down, and that's dismantling, removing, and restoring the place to its original condition. All right, so this is what you're going to do, DRR costs. So now we will look at the case study on the next slide. In fact, there's a case study on the questions that I did give yesterday or the day last week. Passed it to MIA, I think it was Friday or something like that. You may have got it, right? So dismantling costs, it means that they want you to provide for something in the future, never done in the olden days, all right? Before these standards came and before regulators started to pound on all these things, many companies never actually took cognizance of this fact unless you are audited by one of the big, medium-sized or big four companies. Many companies in Malaysia never look at this. Or even if they know, they ignore it, okay? But let's look at it and see what is required to be done. Of course, as an auditor, you need to tell them what to do. So dismantling costs, the MFRS requires that if an entity must dismantle the PPE after a certain number of years, such future dismantling cost forms part of the initial cost of PPE. Remember, we are talking about when you put in the PPE, the initial cost, right? All the various costs, you add on dismantling costs at the discounted value. All right. Now let's study this simple one. Now I made this into a more complicated one, not really complicated, a bigger one in your question. So here it is. Dismantling or decommissioning, whatever you like to call it. So on the 1st of January 2017, manufacturers purchases a PPE plant for cash consideration of 30 million. And this is a big machine. Let's assume it needs a lot of foundation work. Otherwise, when it's operating, it will crack the flow, or you need a lot of plumbing, big plumbing and exhaust, whatever. You need all that. So manufacturers has to dismantle the plant after a period of 20 years. So it is estimated that the cost of dismantling is 5 million. All right, that is 20 years time, right? Now, considering inflation and all that stuff, the value of money that could be up or down, the economic fundamentals affecting the economy, causing the currency to fall, because there's so many factors that will be considered. So we are just taking a figure at 5 million, right? Assuming that the average cost of borrowing is 6%, okay? Average cost of borrowing is 6%. The present value of the dismantling cost all right, which is the 5 million, discounted at 6% per annum over 20 years, is therefore 1.56, rounded up figure, 1.56. Present value of 5 million discounted at 6% over 20 years is 1.56 million. You can use the Excel spreadsheet and use the present value formula on the Excel spreadsheet. Just fill in the numbers or link it to the respective cell, and bingo, you can get the present value just like that. Don't use the net present value. This is present value is different from net present value. For financial instruments, you'll be using different types of values, all right? Net present and future value, etc. But this one only present value. So when you provide for this and you bought a machinery of 30 million, what would be your entry in the books? You will debit the PPE at 30 million, right? No two ways about it. And you will credit either payables or a finance company that helps you to buy this machine, or you paid cash, then you credit bank, if that happened. In real life, of course, nobody pays 30 million. So obviously it's some financing thing. So you are debiting 30 million. You would expect to see 30 million only in your PPE. But because the standard clearly says that the initial cost of the PPE must have the discounted value, all right? When you say initial cost is the discounted value, then the discounted value is 1.56 million. Add this to the initial cost of 30 million. So if you look at this, you paid cash of 30 million, or it's payables, whatever you want to call it, and the plant will be 30 million. And then you need to make that provision on 1.56, which is the initial cost debited. So 31,560. You need to create that provision, right? Under the standards on provision earlier. So credit the provision for dismantling, which is on the balance sheet as a liability side, 1,560. So that's the double entry. So all very nice, but your provision is only 1.56 million. In 20 years' time, you must have an amount of 5 million, assuming no inflation and no currency revaluation or devaluation vis-a-vis the other currencies in the world, assuming, all right, then how are you going to bring the 1.56 million to make it 5 million? Obviously, it's quite simple. Now this, I've done it on spreadsheets, and I've just extracted the spreadsheets here. So let's look at the primary data here. The dismantling costs, right? So the dismantling cost estimated by the contractor in 20 years is 5 million. So the number of years is 20 years. Average cost of borrowing, 6%. How do you get? This is a question day in and day out. I always get accountants asking this question about what should be that borrowing cost that I use, all right, in order to do discounting. Now, different standards may have different, like if you're taking IFRS 16 or MFRS 16 leases, the first one they ask you to do is the interest that is imputed in the lease. All right, that means what is imputed in the lease is not shown there. You know, many lease agreements, if you look in real life, they will tell you you lease this shop lot for 3 years, right? And you pay this rental, but they never tell you inside that lease is an interest bearing. No such thing. But some, yes, right? They will give you a lease a percentage. So this is what you have to look for, whether there is some lease that's already stated inside. But if it is not stated, then you must calculate. So, but that is MFRS 16. But here now we are looking at discounting, because when you use different rates here, it could, if the numbers are very big, have a material change in the amount of the dismantling cost, because this is a factor here. So if you put 6.5 and this figure is very much, you might have an item that that may, I didn't say that it will, that may have an impact. So as an accountant, all right, these people, all the students, as an accountant, they must know that it's about a judgment. We must remember that to be an accountant is not about looking at the books or being smart. It's about using our thinking skills. All right. No amount of study can replace the ability to think and use that knowledge, studying it to pass examinations and coming out and say, I pass. Is honestly no, because I've had a very large share of this kind of people in real life for many, many years. When you interview them, they will tell you about the sky and the moon. But when they come to your office and work and you listen to them and you give them a chance, they don't have a clue what they are looking at. So they disturb others. Hey, what this? Hey, what this? I don't know. I don't know. I learned about it, but I don't know already. So this is not the type of people you want, right? Or rather, the industry wants. What the industry wants is people who learn but no experience. So if you are told something, you don't look blur. Huh? What are you talking about? I don't know. I read this. Some even tell me, yeah, I learned about it, but I gave it back to my college after I passed my exam. So if you got this kind of attitude, what would you expect an employer to look at you and say, oh yes, you gave back, good never mind, no need to think, I will think for you, you just work, but I will pay you the amount. Ridiculous, right? So that's why they need to understand whether this is significant or not significant, whether it's material in relation to that. We need a lot of practical experience. So that's why I'm sharing with you the practical side. The theory is in the books. I think everyone can read the books. You don't need me to teach you what's in the books, right? It's about in practice what sort of borrowing. So usually it's the average cost of borrowing. The reason is most companies will have several credit lines, right? Most companies will use money from the bank, all right? Because most of the banks are always willing to give you money if you are doing good, if you are doing well. They will come and ask you, do you want this overdraft? And then when you got the overdraft or you got some loan, then they'll ask you, every time you look at the account, wow, this company is doing very well. How much can we get out of them for interest? Let's give them some facilities. Let them use so we also can share the profit. The interest is actually your profits sharing with the bank. But that's how the world is. You may have opportunity cost to use your money elsewhere. So it works that way anyway. So therefore, when we are talking average cost means you may have overdraft facilities. You may also have, let's say, term loan facilities. You may also have other facilities like a revolving credit facility. So each one of these facilities will normally carry a different rate of interest. Let's say, just for the purpose of argument, your bank overdraft is 5.5%, and your term loan is 6%, and your the revolving credit is 6.5%. Which interest can we use to do discounting? If you take 5.5 and 6.5, there's a 1% difference. It could be significant. So what the standard tells us to do is this, all right? In MFR, generally, you take the weighted average cost of your borrowings, the weighted average, because overdraft may be 10 million, maybe the term loan is 50 million, maybe the revolving credit is 12 million. You take the weighted average cost of it and use that as your borrowing. Now, what happens if somebody comes up and says, and this is a question I've had many companies, accountants ask this over the years, we don't have any borrowings. How do we do discounting? Well, if you don't have, you go to the Bank Negara website, look under the bank borrowing rates. So the Bank Negara has got all the bank borrowing rates there. So you select your bank. If you're Maybank, take the Maybank. If you're public bank, take the public bank. If you're some other bank, take whatever bank. And look at the rate there. That will give you an indication of the cost of borrowings from that bank. You can use that. All right. So once you got that rate here, you use the present value formula, you'll get 1559023. Just now I rounded it to 1.56, remember? So the double entry is very simple. I'm not going to teach you accounting, but I want you to understand this. So you use that 1559, which is a credit here. All right, this is the credit, the provision. So when you credit the provision, you debit where? Into the cost of the asset, the initial cost of the asset. So your 30 million is now added on with 1.559 million. So it becomes 31,559. And the credit is in the balance sheet as under accruals. Okay. So then you need to increase the amount every year, 6% on this total. Now to the businessman on the street, all right, who is not educated in accounts, he will scold you when he sees this. He say, what the hell, what finance costs are you talking about? I just bought this machine. What dismantling costs? What, I got 20 years. No, you mean you're talking today about 20 years ago, 20 years later. How would you know? Maybe I also did also, he will tell you. I mean, you'll get this kind of rebuttals from people. But you got to be calm, and you got to explain to them. You got to listen, then slowly throw it out here, and then explain to them this accounting. They will still be very adamant about it, but slowly you got to chip at it, and that's my real life experience. Right? Chip at it and explain to them, and veil threats. You know, this account you are preparing under the Companies Act Section 244. And you as a director are responsible. I'm trying to help you not to get fined, 100,000 or 50,000 ringgit because of a stupid thing like this. You see, you must follow. Then the fellow, when he hear the fine, slowly it begins to sink. He doesn't accept it. Begin to think. Then slowly you can win him over. You see, these are things that you are not taught. You cannot teach in the classroom. But real life, I always train my staff. When they come in from the university, degree holders coming in after they finish, this is the few things I teach them. It's not only the accounting, all right? So anyway, here. So the finance cost is debited to the P&L account and credited here. So can you imagine a businessman looking at his account and looking at 93,000 going into finance cost? And he's going to get very angry about this because I never borrowed any money, right? And then the liability will go up, and every year it goes up until the end of the 20th year, it's 5 million. So a lot of concepts in accounting, which is followed, is not very acceptable to an ordinary businessman. Now, don't worry about it, because when the standards came out in Malaysia and became official standards in 2012, right? Before that, it was also there, but it was not actually implemented until 2012. Even the public listed companies had problems, all right, understanding some of these, and because the auditors forced it on them, all right, on the threat of modifying the audit report, so they accepted it. But any others other than public companies found it very difficult to accept many of these concepts here, all right? So this is the thing that you face in the real life outside world. So anyway, after you put that, you can see how much actually goes into your P&L account. Actually, the discount from 5 million to 1.5, right? 3.5 million goes to your P&L account. Now that is a very big sum, right? For no reason. But if you look at it another way, you are providing for a future expense that is definite. So you must dismantle. So every year you provide a certain amount. And this is actually a provision, all right? But it is called finance costs, okay? So this is a thing that not many of the directors or management understand. If you say provision, why don't you debit the P&L provision for this kind of cost and credit the provision? Why are you going to finance cost? In what way is this a finance cost? Because in finance costs, when you're doing EBITDA, all right, earnings before interest, tax, and depreciation, then it is very advantageous because interest is removed. All right, but we're just looking at it on the numbers itself will be not so good. All right, so much for the DDR. Now there is an IFRIC interpretation. What happens? Because over the years, there is going to be a change in the rate because you cannot predict for 20 years now. What happens if there is interest rate change? What happens if there is an inflation and so the 5 million that we provided is grossly not enough? Or there was a deflation, for some reason there's a deflation and our 5 million is overstated. So we can reduce. So how to deal with the change? So this interpretation, which is the International Financial Reporting Interpretations Committee, all right, their interpretation says like that, how to deal with the change. Changes in existing commission restorations. So in the existing one, changes. So changes in the measurement of existing decommissioning, restoration, and similar are accounted for as follows. So they give you using revaluation model and using the cost model. So let's take it one step at a time. Because when you have a PPE, you could be revaluing your PPE. And your PPE today in that books, in the example just now, is not 30 million, it's 31 million. And you provide for depreciation on the 30 million, right? So subject to B, changes in the liability should be added or deducted from the cost of the related asset. Just like the first time when we charged the first amount of 1.56 million into the assets, by the same token, when you change any value, you must go back to the asset and change it, all right? So the amount deducted from the cost shall not exceed the carrying amount. If a decrease in liability exceeds the carrying amount of the asset, then the difference goes into P&L account. So likewise, the amount you only created there is 1.56 million. Can you suddenly create and say, now I'm much lower, I'm going to reduce the amount by more than 1.56? Then that difference must go into P&L account. All right, it cannot be that because over the years you are depreciating, right? You are depreciating the asset. So that's why I say subject to be the amount deducted shall not exceed the carrying amount. Okay. Now, if the adjustment results in an addition to the cost of the asset, so because you're tambaing the cost, the thing is depreciating, but because of this revaluation, you add to the cost of asset. Look at the asset. Can it be recoverable? So that's what it's asking us to do. If the adjustment results in an addition to the cost, then the entity must consider whether this is an indication that the new carrying amount of the whole asset is recoverable or not. Now, what happens if it's not recoverable, it's much lower? Then, very simple, do the magic thing, the test of impairment. All right, increase it and impair it through a different item in the P&L account called impairment. So if so, the test of impairment by eliminating the recoverable amount and the account for any impairment loss in accordance with 136. Okay, so remember, initially charged to the cost of the asset. So over the years, if there's a change in the DDR for any this thing, the entries will be against that, against the asset. So if that amount that you charge against the asset is greater than the value of the asset there, together with this thing, then there's something not right because you may have depreciated the asset a lot. So when the amount is higher, the difference must go to P&L. You cannot increase the value of the asset and say, oh, okay, put here, make the asset look better. And likewise, the other way as well, right? So if you increase the value of the asset, if you decrease, then you have to charge off P&L. Sorry. If you increase, can it be recoverable at the increased rate? Cannot recover, impairment. So people in the market, when you explain to them, they get lost. Now you all are listening, our lecturers, you know exactly what I'm talking. All right. But people in the market get lost. They say, "No, what? You're all making a mess of my accounts," which is not something that it is, which is not unusual. Businessmen don't like to see funny figures. They only know in their mind how much I sell, how much I earn. Roughly, this is what I should have. When you go with them with this kind of things, they get very upset. Okay. All right. Anyway, now that was revaluation model, revaluation going up and down. Now, if you're using the cost model, the cost is fixed with depreciation now. So changes in the liability after revaluation surplus previously reckoned an asset, so that a decrease in the liability subject to be again recognize the comprehensive income OCI and increase valuation within equity. So because when you're, is this something I made a mistake? Yeah, the revaluation, yeah. Because previously, wait, I think I may have, sorry. This is a revaluation, correct. All right, so any changes from previous will go to the OCI, all right? Any increase in liability shall be recognized profit and loss, except that it shall be recognized in OCI and reduce the revaluation surplus within the equity to the extent of any credit balance. So, I think I made a mistake on this one, sorry. This one should be the cost method, and this one should be the, because you can see that subject to changes is deduction from the cost. And everything is about the cost of the asset. Sorry, my mistake. When I was writing this, I mistook it. So it should be the cost model, and this is the revaluation model, terbalik on the heading only. So here, that's why changes in liability will be recognized on OCI, okay, OCI. So any changes goes to OCI because revaluation goes to OCI. Cost depreciation goes to P&L, okay? All right. If a decrease in the liability exceeds the carrying amount that would have been recognized had the asset been carried, had it been carried under the cost model, the excess will be recognized immediately in P&L account, all right? So there again, if it goes beyond something, it goes into a loss situation, goes to P&L. That's what we discussed just now. Now, a change in the liability means that if your provision is increasing or decreasing, indication that the asset may have to be revalued in order to ensure that the carrying amount of that asset does not differ materially from what would have been determined using the fair value at the end of reporting period. Now, when there is a change in the liability, all right, so when the change in the liability is a decrease, you are going to bring down the valuation of the asset, all right, because when you decrease, you bring down. That's why it says, if that change in the liability is an indication that you have to revalue to make sure that the carrying amount does not go below the fair value. By putting this double entry on the restoration and decommissioning amount, it does not bring it down, then you got to make sure you revalue at the end of reporting date, and any revaluation surplus or changes will go back to OCI. So this is a roundabout thing, you know. First, you determine on the changes in the provision for decommissioning. Then you put the entry in the books on the decommissioning. And if the decommissioning reduces the value of the asset below its fair value, then you must revalue the asset on its fair value at the end of the year. And if it's different, change the fair value to the market value and go through the OCI. Okay? Now, which businessman won't get angry, right? Okay. Now, MFRS 101 requires disclosure in the statement of comprehensive income, the change in the revaluation surplus arising from a change in the liability for decommissioning costs. All right, and it must be identified and disclosed as such. So any change, you also need to have disclosure. If your provision for DRR changes, disclose in the notes as well, because 101 asks us to do that. Now, if it's a cost, the adjusted depreciable amount of the asset depreciated over the useful life, where the asset has reached almost the end of the useful life. Remember, it's running 30 years, 20 years, no? All right. All changes in the liability automatically go to the profit and loss account, meaning the value of the asset is coming down, and you're on the 18th year or 17th year, your 30 million asset would have been coming down a lot. But at the same time, because of inflation and currency, the decommissioning cost is going up. So where is that difference going to go, right? So that's why they say that where the asset has reached the end of the useful life, any changes will be recognized. The liability go up, the debit also must go up. So if the debit go up, you mean to say that your asset, which is getting old, suddenly goes up in value because of the DDR. Makes no sense, right? So they are saying if it goes beyond that value, then their real value, you must charge that debit to the P&L account. Credit the DRR provision in the balance sheet, debit the P&L account. Now, normally we never debit the P&L account, right? We always debit the PPE, either debit or credit the PPE. But in these circumstances, when the value of the building has gone so low and you want to increase it, that is a double entry that makes no sense. It doesn't show a recoverable item, neither does it show that this amount of asset is going to earn economic benefits. That amount of debit for provision is no way going to earn economic benefit, as we saw in the framework this morning, right? All right. So the periodic unwinding of the discount, the interest that we are actually debiting to the P&L account and crediting to the provision to increase the liability, as you saw in the calculation, shall be recognized in P&L as finance cost as it occurs. This is where you see I put the word finance cost, because it is prescribed in the standard. The unwinding of the discounting factor goes as finance cost, and it's a debit balance. So debit balance means an expense. It's not the whole of the amount, but only the financing cost after discounting it, all right? So that is what it needs to go into the P&L account. All right, so much for discounting. Any questions, please put on the question. I will be looking at it in a short while, okay? We will stop for tea at, let's stop for tea at 3:45, 3:45. I know it's 3:30 is the tea break. Just bear with me for 7 minutes more, then we'll stop for a 15-minute tea break, okay? Just about 7 minutes. All right, depreciation of PPE, because I want to finish as much slides as I can. All right, now, key points in the depreciation is about component depreciation. I did talk about it a few times this morning, although I didn't use the word component, but I think all of you will know that one machine can have several significant components which have different lifespan. In the old days, nobody did this kind of thing, as I said, right? That if a motor spoiled, you would have charge off the new motor as repairs and maintenance. But it is not very correct in the profit and loss account. So the only way is to break up significant machinery. Now, some people will ask a silly question. Hey, my lorries, the tire must change every 6 months. So do I depreciate the tire faster than the lorry? Now that is where, is that tire a very material part of the lorry? If you say your engine in the lorry, because you're running that kind of distances, will fail after a certain number of years. You got to buy a second-hand engine and put it in. Then you can say the whole engine of that lorry or that bus, all right, will have a different lifespan from the rest of the chassis of the lorry or the bus. Okay, so that's something we have to look at. You must use sense in this kind. If the plant and machinery has significant components and the useful life of each significant component is different, then the useful life must be established, which are the units, and accounted for separately. And depreciation must be done separately. Easy to say. A person coming out into the working environment with this knowledge will first look at a machine. How I know which one is which one? Huh? I have no clue. I am an accountant, but how I know about a machine? So you have to know about machine. If you're an accountant, you're useless with numbers. You have to know how to put the numbers there. So we have to ask the manufacturer, write to the manufacturer, or speak to the manufacturer, or ask them to give you an indication. All right? Your machine here, can you tell me what are the significant items where it will not last for the full length? Or what is the lifespan of the significant? Just have to ask them that. All right, so you got to discuss with them why you want to ask this question. Of course, most of the manufacturers know. So if they give you an indicative item, a value, how many years and how many years and how many years, the rest of the machine, they say, that one all, I leave it to you, but the main one is like this. Then you use the main one and depreciate according to what the manufacturer did. If you don't take that step, this sentence means nothing in real life practice. It means nothing. You look at me, I look at you, where to get, don't know where to get, sort of things like this. Because when it came out first time, that was the first question everybody asked, where to get this figure? Ask the manufacturer, who will know? Nobody else will know. The man on the street wouldn't know. The mechanic wouldn't know. The manufacturer will know. Okay? But because they are big, the manufacturer will know. Now, replacement of components. If any significant components are required to be replaced, the motor, the net book value is got 5 years. You are depreciating every year. So the net book value of that component, when you take it out, write off to the P&L account. Buy a new component. It may be more expensive because of the inflection of time. The new component may be more expensive. Put that in, capitalize it, and start depreciating that again. All right? The cost of the new component capitalize and depreciate over the useful life of the overall PPE. Now, if every other component has only about 3 years more to last, don't depreciate this motor by 5 years, because that is a disconnect, isn't it? If the rest of the machine, because you're using 5 years and then another 3 more years, you put a new machine, a motor in, then you depreciate that new motor by 3 years. That means the remaining overall life of the PPE. Now, all this you have to be on the side to understand why you need to do it. Sometimes you may not. Some machines can last. Now, sale or disposal of the PPE or a component. So if you take out that motor and then you sell it, maybe at second-hand price. So you have a net book value after depreciation, you have a selling price, you get a gain or loss on the disposal, goes to P&L account, all right, of that motor. Now, if you're talking about land and buildings, okay, if you're talking about land and building, there could be a time lag, all right, because these are PPE here, from the signing of the sale and purchase agreement to the conclusion of the sale. This is a problem many companies have, because certain landed properties require approval from the state development authority or state government, or something needs to be done. So when you sign an S&P, let's say in November, and your financial year end is December, and this approval has not come even January or February, and you are going to sign off the financial statement in February. So is this sale completed or not? I got an SPA, sale and purchase agreement. Is it completed? The answer is no, because there is a condition precedent in that agreement. in that the state government must approve. Because if you take it up as sale, and in the unlikely event that the state government doesn't approve, that means to say that you got to reverse the sale, then your account is not correct. So we normally treat that as a note to the financial statement. The asset remains, the PPE remains until that condition precedent is settled. On that particular date, the sale has taken place. All other conditions which are not condition precedent is not relevant. All right. So there could be a time lag from the signing of the SPA to the conclusion of the sale. Could be due to waiting for the approvals from the relevant authorities, sometimes bank loan. In such cases, that sale is only completed when all the risk and reward of this asset and control goes on with the risk and reward is transferred to the buyer. That is the time the real sale of PPE takes place. Why I'm talking about land and building? Because land and building is not like machinery. All right, you agree already? Okay, bring your lorry, take and go. Land, you cannot say, sign already. Okay, now get out. I'm going to occupy the space. It doesn't exist that way. You see that in movies, lah. All right, but this is the real world. Okay, and depreciation. The depreciation amount, of course, we know lah. On a systematic basis, you cannot have a depreciation high at certain time, low at certain times. But what if you want to have it, you can. It must be pegged to something. For example, production units. You can peg your depreciation to production units, but you cannot peg your depreciation to sales that comes out from the plant and machinery. All right, whatever you come out from that and you sold so much and you say, oh, my sale is higher, my depreciation is higher. My sale is lower, my depreciation is lower. You cannot do that. The standard does not permit. All right, you cannot peg your depreciation to a revenue. You can peg your depreciation to the number of units produced. That is possible. In fact, I gave you a question on that as well. All right, after when we go through it, I'll explain that. Now, the residual value, that means the leftover value after the depreciation and the useful life, must be reviewed at least at the financial year end at each. Now, you see, paragraph 36 to 40 is very clear. That the management must review it at each financial year. It never even give you a leeway of every 2 years. Every year, the residual value, the value, is that the value I can recover? And the useful life. We have another 3 more years to run. Can that machine still last 3 years? What happens if you look at the machine? The machine is damn strong, lah. 3 years is nothing. This thing can last another maybe 7, 8 years, you know. What do you do in circumstances like that? We always tend to think the machine spoils faster. But there are machines that last and last. Do you put the value of the machine 0 in the financial statement and it is still producing income? It's still producing units as if like nothing happened. So what do? Well, no depreciation, profit gone up. That is wrong. That is wrong. You got to go back and reassess your depreciation. All right, that means you have made a wrong estimation of the useful life, or rather that company has made a wrong estimation, and therefore you got to reassess and then adjust the thing prospectively. Don't go retrospectively. An error in an estimate must be done prospectively. And an error because of an error in the account must be done retrospectively. A change in an accounting policy is done retrospectively. All right, so we must know which is prospective and retrospective. So in this case, it's done prospectively. Readjust the depreciation over a longer period, recalculate, and do it this year. All right, and that's how it should be done. Okay. All right, next one. Each item of a PPE with a cost that is significant in relation to the total cost of the item shall be depreciated separately. This is a component. All right, they don't use the word component, but they say those that are significant in relation to the total must be depreciated separately. The entity allocates amount initially recognized as an item of PP to the significant parts. Significant parts. The entity allocates the amount initially recognized for the PP. Whole PP is 1 million. Motto, how much? Allocate. Allocation basis, how to do? This is where you got to go back to the manufacturer to find out. The numbers don't drop from heaven. You have to actually find out the numbers, right? And depreciate separately each part. So a plant with significant components with different lifespan. Now, significant component with same lifespan, you don't do like that because all these components same lifespan, so one rate will do. But it's with different lifespan. Electric motor, heating equipment, extrusion equipment, and other equipment depreciate separately. Electric motor, heating equipment, and all this will be separately depreciated. So if you have a logging concession, you know the logging equipment is a lot of things that you have in the logging, and they have got many components to them. So each of those components have a very different lifespan. So you have to actually look at the lifespan of each component. You must have knowledge of this, and the management must get the information also. Now I can go through many industries with big equipment that you need to actually look at which are the components that you need to regularly change, significant ones, not the tires of the lorry. Then you got to depreciate accordingly. Now, if the PP is subject to an operating lease, now here, observe this. This is a depreciation and you are mixing with an operating lease. Now, how does that work? This is in the books of a lessor. Now you think MFRS 16, leases, or IFRS 16. Now, if you have a property that you have in your books as a PPE, as a lessor is a PPE, and people come to you and say, I want to rent your tractor, or I want to rent your backhoe, for example, all right? It's my PPE. I want to rent your backhoe. So I will rent it for 3 years because I got a contract out there for 3 years and I need to use this backhoe for 3 years. So no problem. You say you can take this, the rental you have to pay because 3 years I give you a discount, blah, 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 all that stuff. So what is the books in the books of the lessor? He is collecting rent from you. That is an operating lease on the side of the lessor. Now to the other party who took your backhoe, in his books it's a right of use asset with the corresponding liability. But in the lessor's books, it's an operating lease. Okay? So I'm talking about the lessor's books now. If an entity acquires a PPE subject to an operating lease in which the lessor, in which it is the lessor, then you must depreciate separately amounts reflected in the cost of the item that are attributable to favorable and unfavorable lease terms relative to market terms. Now you see there's one additional factor here. The depreciation is because you are renting the asset, all right? Now, when renting the asset, there could be a lot more factors than you using the asset yourself. So that's why they say depreciate separately amounts reflected in the cost of that item that are attributed to favorable and unfavorable lease terms. Now, grouping similar useful life parts. A significant part of an item of a PPE may have a useful life and a depreciation that is the same useful life as another significant part, as what I said just now. You got 2 or 3 significant parts that are equal lifespan. Then such parts can be grouped. No need to have separate depreciation charge, paragraph 45 of MFRS 16. Okay. All right, now I think I finished this, and we go on to impairment. So impairment is the part that is over and above depreciation. So what we need to do, make sure that the asset is impaired if it is above the realizable value, recoverable value. The question is, how do we know the recoverable value? So this is a question of the judgment of the management. All right, so management judgment plays a very important part on normal assets. So only when you are very clear there's an impairment because the machine is damaged, old, or if you have other assets like goodwill, all right, you cannot earn the money after paying all the goodwill. You bought over a company, you paid goodwill, but the returns from the company is very low. So you may have to do an impairment of goodwill, or you may have other assets like patent rights, trademarks, of which you may have bought a patent right. Now remember, inbuilt items are not allowed to be taken in the account. You only can purchase. So if you purchase a patent right for 10 years, that gives you a patent to manufacture something. After 5 years, there's a lot of competition in the market. More technological advanced items have come out into the market. And therefore, your patent, although you got another 5 years to run, the items cannot sell. And that is going to reduce the value of your patent. So you got to do impairment patent rights, all right, trademarks, etc. Remember, if you are a manufacturer of a phone, or you have a license to manufacture phone in Malaysia, and you have paid a rights to manufacture, right? And you paid a lot of money for a 10-year license. Let's say you took the phone Nokia when it was in the height, and it was during the height of its fame, or it took 20 years. So then in the early 1990s, the Nokia and the Motorola's were the order of the day. Nobody heard of Apple. Apple was, Steve Jobs was playing around with his little computer with a double disk, and we had all the other Apple Mac and all that stuff coming out, not phones. Until 2007, 2008, then came the Apple phones, then came the Samsungs and the whatnot. And look at the whole landscape has changed so much. If you still hold a Nokia patent to manufacture, who is going to buy a phone? I mean, there are Nokia phones. The small ones are used by the Bangladeshi workers. The big ones are not popular on the market. All right, so people want to be seen with a phone. Oh, I'm using a Huawei or whatever it is. I'm using a this. What are you using? I'm using Nokia. Huh? But at that time, things were different. So here again, you need to do a lot of impairment. So it's about understanding whether the value on the balance sheet is still going to be able to generate income to cover itself. That's impairment, okay? Now I can go on a lot more assets. So you have to see the assets on that same principle. Where can it recover? So the standard explains how entity reviews the carrying amount of the assets and how it determines the recoverable amount or reverses. So here again, we are now looking at the recoverability, how to calculate value in use, all that stuff that we talked about. All right. So 136 talks about a little bit of this. I've just taken an excerpt from it because it's directly linked to property, plant, equipment. So in assessing whether there's an indication that an asset can be impaired, we must follow the following thing: external sources of information and also internal sources of information. That's what the standard wants us to do. All right. So external sources is observable indications that the asset value has declined. Example, patent rights for Nokia. Okay, patent rights for Nokia. And what happens if you were given a patent right or you took a right to open a shop selling Papa Rich, the brand Papa Rich food? Now, today they have closed down everywhere, most of the places. But will it sell? People, oh, yeah, Papa Rich, it was okay, but now I don't know. Because the lesser the outlets, people think that the quality of the food goes down. And similarly, many brands that were once popular have now disappeared from the market. So that's why you have to do, these are external sources of information. We got to be very savvy. All right. That's why as an auditor, I mean, I put a little bit of audit hat on. We look at everything, lah. All right. Because an auditor, you must know. Some clients have all kinds of funny things. You got to learn about them, right? So as an accountant, you are a bit more narrow. You are narrower because it will be more towards the group of companies that you are serving in, or rather, these graduates who come out, they will become they may end up in some big companies, but it's very narrow within the range of the various activities. Of course, they got many subsidiaries. Not all of them will get chance to work in every subsidiary, which is different, but never mind, whatever it is. Significant changes with adverse effects taking place during the period, and especially in the technological, market, economic, and legal environment. You see, many businesses are slowly moving into the technological era. When you are talking about impairment, you may even talk about impairment of inventory. All right. Now, at the last COVID, I mean, in this period of COVID, nobody would have actually been talking or having, what should I say, a webinar like what we are doing, like every day, like it's nothing, in a webinar. We'd have thought, oh, must go to the hotel, sit down and talk. How to talk on the phone, this thing, very difficult. But it has gone on for such a long time, and it's a second thing. We used to think, oh, this kind of thing, only boardroom, big directors have this thing and all that stuff. But you see how it has changed. Look at the way today people are shopping online. So online products are moving fast, all right? And look at the retail outlets. Unless you're one of the big retail outlets where people are going to spend time walking to get the air conditioning and then buy, is different. Sometimes today in the retail outlets, as what someone told me when they are still working, they tell me, people come to the shop, yes, in the last a few weeks, but they come to the shop, they look around, then they go off. So he says, probably they look at it, they look at the price, then they go back and look at either Lazada, Shopee, or whatever it is and buy from there. Right? So you see, the way of shopping is moving slightly differently. So if we don't keep in touch, your inventory will become obsolete and you cannot sell. And inventory is something very, very sensitive. Keeping it is going to turn old, changes color. When you go to a shop, are you going to buy something old? No, isn't it? You say, oh, it's not very old, right? I don't want to buy that. I want a new one. So this kind of things are taking place. Internal source of information, all right, obsolescence by looking at the assets, whether it's getting obsolete or it's damaged, maybe due to the downturn and the lockdowns, your company or a particular company has reduced sales, has reduced products that are being manufactured because of difficulty in getting the raw materials, difficulty in operating the factory because of lockdown, because of COVID. Sometimes COVID, your factory must be closed. This must be closed. So many factors are taking place. And so what's going to be happening to all the equipment getting idle? And then there's no more demand for your products because the community has moved on. Life is moving on. So evidence of obsolescence, physical damage of asset, significant change with the effect of entity taking place, like assets becoming idle. Sometimes people say, yeah, very difficult, I'm losing money on rental, I'm losing money on staff, I cannot get income, and the income that trickles in is not enough, because you must remember, we were full blast, and suddenly shrink like that. Not everybody is a glove manufacturer or a mask manufacturer or manufacturing something that is health products. Those people are booming. So some of them may say, okay, I closed down. Look at the number of companies that have closed down. Big companies, not small ones. All right, some have restructured and plan to dispose an asset, early. So all these are bound impairment, internal sources, or reassess the useful life of certain type of assets, right? Not all, but certain type of asset, depending on the industry. You have to go by industry, all right? Evidence available from internal reporting. showing about the performance is going really down. What would you expect? All the assets to remain intact, right? So definitely the economic performance of the asset will also go down. As I say, this all you must be on the site to see things. You will see different industry facing different problems. It's difficult to generalize in words. That's why I always encourage that after you study about impairment, that knowledge is actually your foundation. But when you go out, so many things will change. Okay, you can see a lot of things where you apply this. All right, on to the next slide. Sorry. Now, because of this impairment, you might get some kind of compensation for third parties. All right, goods that are impaired, lost, given up. So when you receive the compensation, where do you put it in the financial statement? It shall be included in the profit and loss when the compensation is receivable. Do not set off that compensation against the PPE. No way you should do that. We put it as part of the P&L, all right? As included in the P&L. That is, the compensation for items that were impaired shall be included in the P&L when it becomes receivable. For impairment of losses like PPE, related claims to PPE, or compensation from third parties, right? Then subsequent purchase or construction of replacement assets, they are all separate economic events that you need to account for separately. So there are variety of compensation from third parties because of this. Even companies will get, the government give you some kind of assistance. That's actually a compensation, right? Impairment of the item of property, plant are recognized in accordance with 136. Over and above depreciation, add on, tambah lagi on the compensation. On the impairment. Sometimes you may have to sell off some of your machines in order to get cash flow during this lockdown period. I've seen that happen in a few companies. They sell off some, but not very much, right? Some of it in order, sometimes it's due to cleaning up. Now is the best time to clean up things, so get rid of it. So you need to do some impairment as well, or disposed of in accordance with MFRS 16, which is the 116. Compensation for items that were impaired, lost, or given up is included in the profit and loss when receivable. And the cost of all PPE restored, purchased, or constructed as a replacement to damages. Sometimes some of your assets could be damaged and you are compensated for it. All right. Maybe there are some assets that could be compensated. So all this will be determined in accordance with an MFRS 16, the replacement. All right, now asset sale, de-recognition of a PPE, all right? So this is easy part. When you sell off, it's de-recognized. Either you dispose or no more economic benefits, sell it as scrap or throw it away, okay? Sometimes selling as scrap also people don't want to take it, you see? So you got to find a way to get rid of it. I mean, if they are metal and stuff like that, maybe you can sell it, right? Now, the gain or loss from de-recognition goes into P&L account when it's de-recognized. Never take a gain and classify a gain as a revenue. A gain is never a revenue. It is shown as other income or gain on disposal of PPE. The reason is revenue is actually under MFRS 15. Revenue is revenue from contracts with customers. So when you go and sell this, that is not a contract with customer in the meaning of the word contract. This is selling off an asset. So the revenue contract with customers is your operational revenue, not asset sale revenue. Okay, and also the conceptual framework tells you what income is. So some entities, in the course of ordinary activities, as what they are doing now, sell items of PPE that was held as a rental to others, right? PPE, which is on rental, sell it off. Okay, that is sell. And now the standard says like this, when you have an item for rental and you want to sell it, you must transfer it to inventory. So you are a shipping line, a shipper. You own a lot of a ship, all right, for people to charter the boats. You have plenty of boats, and a boat goes on a voyage, either carrying goods overseas and come back. So you can charter on a voyage basis. So the question is now, all these items of boats now you say not much demand, very slow, and the cost of maintenance of the boats is very high. I'm going to sell off my ships. So although your ships are out on rental, when you want to sell them, you must transfer the ship into inventory. All right, your ship is a PPE. You want to transfer into inventory. So when it transferred into inventory, then when you sell it, that ship becomes revenue, because sale of inventory is revenue, and that is under the standards. All right. So although we can look and say, hey, sale of ship is a fixed asset, how can it be revenue? It should be a gain on disposal. No, you need to transfer to inventory. So the proceeds from the sale will be recognized as revenue, because now MFRS 15 triggers in, because it is an inventory item. It's not an asset for sale. Okay, this is the strange thing. You bring down and you sell it. Now, MFRS does not apply when the asset held for sale in the ordinary course of business are transferred to inventory. MFRS 5 applies when an asset is taken out from the PPE and put under asset held for sale. All right, when an asset held for sale as a separate classification, you don't depreciate it, but when you sell it, it's an asset that is sold. But if you are looking at assets like this, ships, when you want to sell it, you must sell it by transferring to inventory, right? Strange, but this is the standards, okay? Now, land held for development shown as PPE, all right? Those will be land held for development. So land held for development is a non-current asset. Or when you develop it into a houses, then you have land and development expenditure, which becomes inventory. And when you sell that houses, it's part of revenue. Okay, it does not say, oh, land held for development, when I sell, is assets held for sale. No, there is a difference here. Okay, the disposal of any PPE may occur by many ways. Either you sell it, or you can also sell it by way of a finance lease. Remember, just now I said a lessor having the assets, he can rent out the assets, it's an operating lease. He can also sell the assets and give financing. It becomes a finance lease. That is a disposal of an asset, right? So this is what is meant by entering into a finance lease or by a donation. He can dispose it by a finance lease, means sell it and give him finance for 24 months, 36 months, whatever. That becomes finance lease. Now, the date of disposal of PPE is at the date the recipient obtains control. The word control is important here, of that item in accordance with requirements of MFRS 15. Now, control is a very complex word in MFRS 15. In different circumstances, it means a lot of things. So that you have to really understand control. What is control? Because revenue can only pass to the seller, right, when he has relinquished control on the asset, right? Ownership and all that's another thing, but control. All right, so MFRS 16, which is on leases, applies on a disposal by sale and lease back. So if you have an asset, you want to dispose to the finance company, so you sell, and then you lease back from them. So this sale of asset becomes a disposal under the MFRS 16, which will then show it as a sale under MFRS 15, and the lease back is under MFRS 16. So MFRS 16 refers to 15 as well. That's why when you adopted it, you must adopt the two standards together, right? And recognition or derecognition or replacement part. So here is the replacement part, which we talked about earlier, the motto. The motor is getting old and it's already 5 years. So you take out that item and replace with a new one. So when an entity recognizes in the carrying amount of the item the cost of a replacement part, then it de-recognizes the carrying amount of the replaced part, the existing motor, take the new motor and put it in. All right? Regardless of whether the replaced part was depreciated separately. So the motor sitting there, not being used. The question is the spare motor, remember, you have to put it in PPE. Do you depreciate it or not? All right, remember, the principle of depreciation is when it is available for use, not put to use. But it looks very ridiculous when you have a spare motor sitting there to take over the motor in the machine when it breaks down, to say I will depreciate the motor. So there's a mismatch here in the standards. So that's why they put here, if whether depreciated or not. Okay, so you must make sure that usually we don't depreciate the spare motor because although it's available for use and not put to use, the rule is depreciate when available for use. All right, but because it looks a substance over form doesn't make sense. Because eventually when you put it in, what do? All right, don't depreciate it or what? Doesn't make sense. The standard is silent on that. All right. Now, if it's not practical to determine the carrying amount of the replaced part, the cost of the replacement may give an indication of what the replaced part was. So if you're going to actually determine what will be a replacement part, the cost when you replace it, in order to make sure you know that cost of the motor, all right, the motor came one lump sum together with the machine, but you don't know how much is the motor and you can't get it from the supplier. Then they're asking you, look at similar motors, go and get the price, use that as the indicative price of what the replacement would be, and therefore depreciate it accordingly. Now that is another way of doing it. And any replacement parts that you sell, of course, goes to the P&L account as a gain or loss. All right.